Hi everyone, welcome to another segment on Chapter 3. And in this segment, we will go into a little bit more detail on measuring GDP using the expenditure method and measuring GDP using the income method. In the last segment, we introduced the expenditure approach and the incomes approach. And in this segment, we'll go into it in quite a bit more detail so you can calculate and look at these things yourself. Okay, so here we go in just a little bit more detail, and then we'll expand on it. Measuring GDP, the expenditure method. So like the last segment, this is going to have to be pretty much the same thing, only a little bit more detail. When we wanted to find GDP, we said using the expenditure approach, we add up the spending on consumer goods and services. So we've got that right here. That's consumption. Just follow the mouse over here. Spending on consumers' goods and services, and that includes durables like, a refrigerator, non-durables like maybe a new pair of jeans, services like my haircut, a cup of coffee. So that's the first component of measuring GDP, gross domestic product. Then we also add up investment, and we actually look at gross investment. And remember, it's investment in capital goods. So that means, machinery, building, new tools, construction, stuff that a company uses to expand or grow its business. It's not financial investment like stocks and bonds. And then we add up all government spending by all levels. So the federal government, the provincial government, the municipal government, they're all involved. So we add up that government spending. And then we look at net exports and include that. And that is exports, but we subtract the level of imports because it's the net exports that we're interested in getting here. So to get GDP, it's just simply the sum of these things. It's consumption plus investment, gross, plus government spending, plus exports minus imports. That's our formula for GDP. Now, the most popular and most widely used measure of economic activity is GDP, or gross domestic product. But sometimes someone might be interested in net domestic product. So net suggests that we have to subtract something out from gross domestic product to arrive at net domestic product. And those two things are depreciation and taxes. The value of the capital goods, as you know from your accounting courses, decreases over time. So that has to be constantly replaced. So the net investment that we look at is really the gross investment minus this depreciation, which has to be replaced. So it's a smaller number than gross investment. As well, indirect taxes are sales taxes that businesses collect for the government, and they don't really represent any kind of productive activity. So we want to take that out of the value as well. And if we take gross domestic product and we subtract the depreciation and subtract indirect taxes, then we do end up with something called net domestic product. So here's that formula for net domestic product, where we account for depreciation and indirect taxes. So if we take our gross domestic product number, remember that's C plus I, G, plus government spending, G, plus net exports, X minus IM, and then we further subtract depreciation and indirect taxes, we end up at something called net domestic product. And we'll see these calculations very simply in a table at the end of this section that we're going through. So we may want to take this one step further. And after we calculate net domestic product, we may want to say, okay, that's the value of production inside Canada. Domestic means inside Canada. That's the value. So whether it's gross domestic product back here, GDP where I'm hovering, or net domestic product after accounting for taxes and depreciation, both of those are level of economic activity inside Canada, whether or not it comes from Canadian citizens or foreign citizens working in Canada, or Canadian companies or foreign companies working in Canada. It's just everything inside the Canadian border. So maybe we just want to look at what are Canadians and Canadian companies doing, or what are the nationals doing? So we're going to calculate something called net national product. So just as a recap here, if a foreign corporation operates in Canada, some of the profit may be transferred out of the country. And if a Canadian corporation operates outside of Canada, some of the profit is transferred into the country. Also, foreigners may be working in Canada, and some Canadians may be working abroad, and we need to make adjustments for those income if we want to look at something called net national product. Remember, national means just Canadian citizens and Canadian countries. So we go one step further in the math. We started with GDP, we went to net national product right now, and we got here by saying net domestic product plus or minus the net foreign factor income. That net foreign factor income is referring to the level of income that Canadians and Canadian companies make outside the country and the level of income that foreigners and foreign companies make inside the country. So we make that adjustment just to account for the Canadians and the Canadian companies. So we can go from gross domestic product to net domestic product to net national product. And keep separate those three different definitions and you'll be in good shape. Now we're going to look at the actual gross domestic income side of things. So here we go. We're looking at gross domestic income, and we need to add up these particular things. First of all, we start with compensation of employees, and then something called gross operating surplus and gross mixed income, and then taxes and indirect taxes. Well, compensation of employees, we have to separate these into three categories, so it might make sense to you that compensation of employees, well, that's the household's income. These next two, gross operating surplus and gross mixed income, that's the businesses or the corporate income. So we can put down here the big letter B. And if you read in the text, you can split this apart a little bit. Gross operating surplus is, gross profit before depreciation and profit tax. And gross mixed income is non-incorporated before depreciation and tax. But just go through the text to get the details that you want. But these broad categories are what's more important here. And the last sector that we need to account for, because we're looking at the income of all three sectors, the last sector would be the government sector. And that makes sense because we're looking at two types of taxes. So all you need to do in tables that you'll be given is pick those out and add them up. And that's how we get at the gross domestic income calculation. So now we put the two approaches side by side. We've got the expenditure GDP accounting and the income GDP accounting approach. And we'll see that they're exactly the same because in equilibrium, they have to be. What on one side is the aggregate expenditure in the economy, it must equal on the other side all the income to the factors of production, including profit. So it's no surprise that they turn out to be the same. It's by design. But if we come over here and we calculate GDP, I'll just write it in here, see if you can follow this. GDP, we said, was consumption plus gross investment plus government spending plus net exports. So it's C plus gross investment plus government spending plus net exports. So when we do all that, that's these here. 1, 2, 3, 4, and we end up with 1983. That's our GDP. I should actually put plus signs here so you don't think there's any subtracting going on. So that's our gross domestic product using expenditure approach. Okay, then we said, well, what if we want net domestic product? We're still looking at what's happening inside Canada, whether it's foreign companies and foreign people or domestic companies and domestic Canadians. We're still looking inside the borders. But if we take GDP, gross domestic product, and we subtract the depreciation, and the indirect taxes, that's these here, then we end up with net domestic product, and in this case, it's at 1513. So you see we're going from gross domestic product to net domestic product, just using those simple categories, which you'll always be able to figure out. It doesn't get any more complicated than this. But then maybe we want to know what's happening just to Canadians and Canadian companies. Not very often. By far, we just want to know what's happening. It doesn't matter who they are, where they're from, where the companies originate, just the level of economic activity inside Canada. That's GDP. That's by far and away the biggest one we look at. But if we want net national product, then what we do is we take our net domestic product, which we just calculated, and we add plus or minus the net foreign factor income. And in that case, it's right there. And when that shakes out, we end up with net national product of 1486. Okay? So it's just, that's the extent of the accounting in this course, but you need to understand the concept, the difference between the expenditure approach and the income approach. So let's do the income approach. So to get the income approach, we simply add, to get our gross domestic income, we add household income plus businesses income plus government income. And here they are. There's our household, gross operating surplus and mixed income, that's our business. And then taxes and taxes, well, that's a dead giveaway. That's our government spending, or sorry, government income. So when we add all those up, we get 1983, and it's GDI at market prices. Well, look, 1983 here is gross domestic product. 1983 here is gross domestic income. So I said it was the same. Then if we want to get net domestic income, we take gross domestic income and we subtract depreciation and indirect taxes. So we're subtracting the same thing. That's why these are so consistent. It's exactly the same thing happening on both sides. So we subtract depreciation, indirect taxes, and we end up with 1513. And that's our net domestic income. Well, look here, we've got net domestic product, 1513. Here we've got net domestic income, 1513. They have to be the same. And then to get net national income, we're going from domestic, just happening inside the borders, to national, which means just focusing on Canadians and Canadian companies. Well, for that, we take net domestic income, and we do the same thing over here as we did on the left. We plus or minus the net foreign factor income, right? That's looking at focusing on just what the Canadians and Canadian companies are involved in if we ever want to look at that. And we also get 1486. So they work out to be the same. In Connect, when you're doing one of these tables, the trick is realizing that this 1983 equals that 1983, this 1513 equals that 1513, and this 1486 equals that 1486. So you can mix and match and fill in the blanks and calculate the correct numbers just by backing some of them out. So that's a nice side-by-side comparison between the two. And we'll take a look at a little bit more. So the last slide that we look at here is we're going to look at calculating personal income and disposable income. So personal income is actually a person's or the country's personal income is their gross income. So if we just write YP, that's the personal income. It's a person's gross income. And we arrive at it by starting at net national income. And we start at the net national income number that we have. And this will help you with your calculations in Connect and on exams. And you add the transfer payments. And the reason you add transfer payments is because at first they're excluded because they're non-productive. There's no production that occurs in the economy. It's just something given to people. So we want to get that number back in because it's definitely part of their income. But then there's something called undistributed corporate profit tax. So I'll try and write as much as I can here. Undistributed corporate profit tax. And that's taxes that the corporations keep. Now, it represents production because it's part of their economic effort, but it doesn't get distributed to people, so we have to subtract it. It's undistributed, so it comes off of this large net national income number. So then we also have to subtract undistributed corporate profit. For the same reason, it doesn't get given out to individuals. If it does get given out, it's included in their personal income. And then we just have other, an other category. So you take those numbers, net national income, you add transfer payments, you subtract undistributed corporate profit tax, and you subtract undistributed corporate profit, simply because those aren't given out to people in the form of income, and you arrive at personal gross income. So that's the formula you need to know to do some of the work in the text and then connect. And then disposable income is what I really just get to take home and use. And all that is my gross income minus the taxes that I pay on that. So it's minus personal income tax. That one is probably a lot easier for you to intuitively grasp. Personal income tax. So there's our two methods to get to personal income and to get to disposable income. Defining the both of them again, personal income is a person's gross income. Disposable income is the net income that people take home after income tax. So it's what I get to, to play and spend at home. Finally, households, well, they can choose to either save their disposable income or use it for consumption. Now we're not talking gross income, we're talking YD. So that's my disposable income. That is either consumed or saved. Sorry about my messy writing on here, but the disposable income is either consumed or saved. Gross income is either consumed, saved, or you pay income tax on it. So hopefully that helps explain this whole part about national income accounting, gross domestic product, gross domestic income approaches to income accounting. And later on in our next segments, we're going to go ahead and look at some of the problems in GDP and then some measurements of economic growth and that sort of thing. So we'll see you when we get there.